Good afternoon, ladies and gentlemen, and welcome to today's Stock Market Brief Show. I'm out here in Las Vegas, Nevada, in a hotel room over at the Paris, at the Money Show, trying to learn, educate, network, and do all kinds of cool stuff out here. But I had to find time to step away and put out a Stock Market Brief. I don't want to get into it. We're going to be diving into a few charts here. I'm going to be talking about some divergences that I see, some intermarket stuff, expected moves, and market conditions. There's going to be timestamps in the description. I'm going to be getting right into it today's episode because the market it's right now on the cusp of really seeing an explosion, an expansion of volatility. And I'm going to show you this by one of the very simple, basic principles of technical analysis, and that is that markets, assets, all move between periods of expansion, right? Boom, to contraction, right? Smaller, and they go back and forth and so forth. And this right here is a Bollinger Band width. So basically, you know what Bollinger Bands are. They're the bands that have an upper, lower, they have the midline, and they basically go big, and then they come in, they go big, and they go in. And basically what it's measuring is when the asset's volatility expands and contracts. And what am I showing you right here? This right here is the Bollinger Band width, and you can see that it's pointing straight down, right? What does that mean when it's pointing straight down? It means the Bollinger Bands on this given asset are getting incredibly tight. They're contracting. Now, if you look through the history of this, dating back to 2021, 2022, 2023, 2024, and where we are now, 2025, so multiple years, the asset that we're looking at right now is at its lowest point really since 2021. Going into around 2022. So about throughout that year, we saw multiple spikes. This asset that I'm looking at right now is the SPY. So what does this mean for the market? Well, as we know, the market has been tied up in a very tight range. In fact, it's been ponging around that 6,100 level multiple times and getting rejected. We're going to talk about where the market could potentially go if it goes to the upside of a quick explosive move, which we've been talking about the potential for a bull trap. And we'll kind of mark out those specific levels, but not necessarily set the trade up for a bull trap, right? You never know how crazy these things can potentially get. And we'll also talk about the conditions of what to watch for just in case if we start to slip and start to sell off in the market. Now, what does this look like dating back, to 2021? And what has happened on the chart of the S&P 500 when we did that? Well, look at the Bollinger Band width down here. Up here is the chart of the SPY. That's the proxy that I'm using here. You can put it on ES, you can put it on SPX, you can put it on any asset that you want. And as you can see right here, the Bollinger Bands, right, are not displayed on the screen, just the width, right? But as you can see, now the Bollinger Bands are the tightest that they've been. Why? Well, price action's all been consolidating. It's getting very, very tight. Now, the last times that we've been down at these levels, I want to take you back over to here to 2021. And what did you notice when this one didn't quite reach down to these levels? This one did, this one did. What do you notice that happened? Well, as the price action was moving sideways, we saw explosive moves in both directions. Now, that's hard to see, people. I know it is, okay? I'm on my little laptop here. It is what it is. But what we saw here was a quick hit to the downside, a quick hit to the upside, a quick hit back to the downside, and then it expanded. The volatility expanded. The Bollinger Bands expanded. And then we came back in for a new period of contraction. So it got very tight in here and boom, we set off and boom, we came back in there again. As the volatility bands, they started to expand there as well. Right over here, what happened? Well, we saw a move up and then bam, we saw volatility pick up, but to the downside. Remember, when people hear volatility, they typically think negative things, but volatility in and itself goes both ways. Right? You can have volatility expand to the upside and the downside. The key here is to be on the right side when volatility expands and mitigate risk, obviously, if you're on the wrong side. You can see over here too, in November of 2021, we saw boom, hit to the downside, up, down, boom. And then we started to sell off there as volatility really started to pick up there in the bear market of 2022. More recently, in 2024, we had price action go to the side. The bands got very tight and we saw a big explosion to the upside. Over here more recently there was in March and we saw a quick hit to the downside as it shortly there recovered. So why am I bringing this up now? Is because this is the area where when volatility expands, we can have a clean just shot move, right? We can have a clean breakout, right? Because the price action looks very bullish right here. Let's be honest, right? We're seeing higher lows right here. Okay, price action has been going sideways. Some breadth has been improving. We'll talk about divergences. But if it does break out and expand to the upside, our goal is to hope, right, that you're on the right side of that, and then that it trades up to some key levels, which we'll dive into. in a clean shot manner. But I want you to just be aware that as volatility expands, which we're just using the Bollinger Bands as the proxy here, as it expands, you can get some very wicked two-sided trade. And this you just got to be aware of, because if the market conditions change, sometimes that's better for various day traders. Sometimes your strategy might have to adapt and so forth, right? So that's what I wanted to call out here. Just very interesting chart. I haven't heard a single soul point this out, but yet it's very, very important, right? We all know what's happening on the chart, but what we don't know is just how influential how tight these bands actually are comparatively, right, to where they've been in the past. It's been a very long time. Let's talk about some divergences in the market, and then we'll get a little bit more tactical here. I got a couple of trade kind of setup ideas, interesting things that are taking place too from a larger market cap perspective in the expected move section. So here's the divergences that are pretty bullish, right? So this one's at least the bullish one. This is equal weight QQQ, right? So it's QQQE. And we had a pretty large breakout, nice move today there. And it's also matching up with kind of the Qs here, but equal weight's actually, outperforming here. So this is good. It's a good sign to see this breadth within the tech sector, right? This is equal weight. I can't say the same for equal weight S&P 500. So this is the S&P 500 down here. New closing highs. Congratulations. And then we have SPXEW, which is the equal weight S&P 500 index. You can also look at RSP. But I do want to call out that, yeah, this is diverging here as this one's going up. But I will like to call out what the price action looks like here. It's pretty bullish looking. As you can see, we kind of hit this double bottom, and now we're kind of consolidating and trying to break out today. So this very well may have what it takes, right, to expand north to the upside. So if you are interested in equal weight, perhaps take a look at RSP, and it'll probably look just like this. I haven't pulled up the chart, but if you do trade that, you can play it back up to the all-time highs, maybe even higher. It's a catch-up trade, but then you have a clear idea of where to put levels of risk. Okay, another way to look at equal weight is the Value Line Geometric Index, XVG, and this one also has been diverging from the S&P 500. We've seen this countless times in the past, and it led to some market sell-offs, but we don't know how long the divergence can last. I just know as it grows with time, it needs to resolve itself at some point. So that's going to be an important one to watch. Another one that I've talked about multiple times is the housing market, right? The housing index, so HGX up here, boom, boom, ba-doom, and we have SPX down here. And, these divergences, once again, they can build over the course of time, right? In 2005, the housing HGX topped, and then the market, right, kept on going up for another couple of years, but that divergence over the course of time became more and more potent, and that led into the great financial crisis. So it does, from a longer-term perspective and even a shorter-term perspective, give us some insight into the market. And you can see here, right? Look at the housing index back over here going into 2022. We didn't make new highs, but the S&P 500 kept on trucking up higher. So that was a little bit of a, sign. Perhaps we would have broken out, and that would have been a good sign. But down even here on a bullish perspective, remember October, right, of 2022 when we found our bottom on the hottest CPI print in a very long time at 9% or so? Well, guess what? The housing market already put in its low at that point, and then the S&P 500 put in a lower low. So this was actually a bullish divergence that led to the upside. And now in recent time, what do we see? Well, we're seeing the housing market come off as rates kind of, we've been seeing an increase in the 10-year yield, which does put pressure on this. We've tracked that correlation. And the S&P 500 is putting it new all-time high. So if rates kind of cool off a bit here, looking more specifically at the correlation with the 10-year, perhaps that, allows the housing index to catch up, but the divergence is something to watch and continue to track. Another interesting one here is the NIMOT, right? The NIMOT, or the Nisey-McClellan oscillator. This is the traditional calculation. First and foremost, I'll show a chart of the Nisey, or the New York Stock Exchange index. It doesn't look bearish, but it is contracting here where it looks like it's going to be making that move very, very soon. But I do want to call out that I pointed out these divergences all the way back here. So anytime you see these red lines, there's a video about it, me calling it out. Same with the green lines and the bullish divergences, including the most recent one right over here in 2020, going into 2025. But you do see that we got an extended reading past about 150. It's been putting in lower highs while the market has been pressing higher. Now, this can resolve itself by the market breaking out and getting new breath and seeing this uptick. Okay, but on a breakout, what happens if this turns around and puts in a lower high? Well, it would be a new negative divergence. Now, if I show you the chart of the NYSE, you can see here, right? Getting very, very tight. Even the Bollinger Bands I have on this right now, and it looks like it's about to start just an expansionary move here. So just be prepared for that. I'm not going to dive too much into the remainder of all of this stuff, but there is some bullish aspects here. Like if you look at the NYSE advanced decline line, and you apply 50 EMA, it has crossed over. And when it does, you get some bullish breath. The NYMO, it is above zero, which is the NYSE McClellan oscillator. Different calculation, but it does have that negative divergence. And if you look at the NYSE relative to the S&P 500, it did get back above the 50 EMA over here, which is a positive sign. It's still declining, but it's been positive for a little while, and it's been overall a downtrend. So that's a positive sign here too. You got new highs, new lows, both in here, and you're seeing a little bit of an uptick in the new highs there as well. If we look at the NASDAQ composite, same chart, but using the NASDAQ composite internals, just to give a good idea of market breadth. This one's also, right, just been consolidating, going sideways, getting ready for an expansion of volatility here in that near future. Let's look at some of the intermarket charts, see what's going on there, right? So I like to look at the dollar, I like to look at yields, right, S&P 500, amongst many other assets. But what I've noticed that's most easiest to track here is when you do have a falling dollar, it benefits any asset that has a strong negative correlation to it. And there's a lot of them there. So a lot of the times, if you know where the dollar's going to go, oh man, guess what? You have a huge advantage to every other investor, trader out there. And then you have the 10-year yield. So these both been going down. What's the S&P 500 been doing? It's been going up. What happens if the 10-year yield starts to break out and the dollar starts to move up? Well, that could put pressure back into the markets. Maybe perhaps the dollar might fall and the 10-year yield goes up and it's trying to stabilizes, and we get that more of that volatility and more of that chop. You can see back over here where the dollar fell for 6 months or so. The 10-year yield fell for that 6 months or so. And what did the S&P 500 do? We saw volatility, but overall we traded higher. If I look at the bridge bands, where they stand within this, I do want to call out that the dollar has slipped into a negative trend. Okay, the lower band is getting below that trend length right there, which I'm just using the midline of a Dawn chain channel. Nothing too crazy right there. But I do want to call out that we're at the lower level of these bands over here, and sometimes you can see snapbacks, but just know that the trend is starting to change. The last time we went from a trend change was actually over here in September. And we started crossing over that midline, and that led to a nice big rally in the dollar. The 10-year yield over here is still holding up, right? We talked about it right when it got to this lower band, right? And it says, hey, just be careful here because you can see a snapback. Well, we came right back to the upper portion of it, and now we're kind of just doodling around more of a neutral stance of the trend as the lower band has slipped underneath it. So this, it's kind of neutralizing itself. So there's not really a bias currently right now, other than if we're just looking at price action alone, we're seeing higher lows, but this could be the first lower high that's really kind of coming into place here. If we take a look at crude oil is important to track. Why? Because this is actually a great commodity from an intermarket standpoint that you can watch to potentially get an edge on where bond yields are going to go. And right now we saw a little bit of a move higher there in crude oil futures. It is in a bearish trend. So if we start breaking to the upside, we do have about a move around 74. And that would potentially give us, run into some hesitation there, as both these band levels have slipped below that Dawn chain channel. So we'll see what happens if we do get some sort of a bounce up into these levels. Perhaps that adds a little bit pressure on the bond market there too as well. Okay, another interesting intermarket asset that I like to track is Bitcoin. And this is a tool that I use. This is called the Sailor to Shift tool. I measure and map the rate of change between Bitcoin and gold. It gives me buy signals, sell signals, and then I created a strategy to give me triggers on those, right? And people have looked at this and they've altered it and changed it the way that they want to change. But in short, really quick, I'm not going to talk too much about this because I got more charts to go over. But we did slip into a sell signal a couple weeks ago there, or a week ago. And the trigger was identified too as well. And we're basically down a little bit since that trigger. And I'd like to see this turn back up and go more positive rate of change to feel more confident that Bitcoin's going to actually progress further here. When we go through these periods of consolidations, you do get whipsaws, but the last real good buy signal was breaking out and it caught the majority of the move. And now it's kind of just been chopping us up in these last 4 or 5 weeks or so. If you take a look at the price of Bitcoin by itself, I mean, we're hanging on, right? We're hanging on. People might look at this as a double top, RSI diverging, right? Cool. It is what it is. I'm just looking to see maybe we break this trend and head back up. And then guess what? Then we're just back in a basic range for the price of Bitcoin. So I'm optimistic, but I'm just cautiously optimistic because there's various signals that told me to just step aside. If you look at Bitcoin relative to the S&P 500, it's actually underperforming the S&P 500 too. And this is a risk-on type asset, right? High volatility. It's a risk-on asset, and it's slipping and underperforming the S&P 500. The last time we crossed crossed the 50 EMA, the relative strength line, that is, it was over here, and you can see that led into some really bullish momentum. So is this going to lead potentially into some bearish momentum? Well, I guess we need some confirmations to, to feel more confident. Let's take a look at some of the expected moves going into tomorrow's trading session. We've got SPY's expected move. The daily implied move is 614.34, 608.56 to the downside. Now, I want to be clear here. This seems very small, like very small. Especially when I compare it to the VIX IVOL bands, which is just a simple indicator that I kind of compiled that gives me the numbers based off of the VIX, and it gives me an implied mood based off of that for the single day. And typically you don't have this wide of a range between the two. So if we're going to begin that expansion of volatility tomorrow, I would be looking at that weekly implied move at about 617. That's where we can go. That would be the target ideal level. We'll see, right? We'll see what's on deck and so forth. But this is kind of the upper zone. This would be the lower zone. So the more bearish levels would be down back over here. And, obviously we have the lower weekly implied move down there too. If we look at the Qs got their upper weekly at 546. The lower is at 529. You can screenshot these levels, put them on your screen. The orange lines, right? Those are weekly implied moves or expected moves. It's what the market priced in for the week ahead, which is this week. We got these levels on Friday. These daily implied zones is what we priced in at the close of business today, going in for tomorrow. So this is what the market says, hey, this is what we're looking at for tomorrow. So if we sell off, that'd be right into an inclining 5-day moving average, be in this zone. Or if we start to break out, I'd be looking up into these upper levels there too as well. Because I'm out on vacation, I decided to give you guys a little present. If you don't know that I have a Discord, the link will be in the description and the pinned comment. It's $9 a month. It's a little bit cheaper if you buy it annually. Every week I supply you with a big list of these implied moves. So if you'd like to just screenshot this and maybe map some of these assets out, we get various sectors, some big cap stocks, some big movers, index products, and you got your upper level, lower level, 2 standard deviation levels because we know that that's always a possibility. And then you get your weekly expected move there. Now, I have history dating back a while now that you can go back and even look at all the other history of these expected moves. But every week I'll give this, and then every day, every month, every quarter, right? I give a bunch of these levels to help really kind of help you define what risk might look like, at least what the market's pricing in as far as risk. So this right here is for this week. It is a shortened week. There you go. And on that note, I'll talk about some of these assets here. So I'll start off with Meta. Meta saw some sell. Meta's been on a huge win streak, right? Now it just had a down day, first in like 20 days or whatever it was. And look where we came to. We came to its weekly implied move right out of the gate. Boom, we started bouncing up. And guess what? We came down, sold off, and guess where we closed? Shoop, right back at that weekly implied move. One of the common things that you see typically happen is once you come down to an upper or lower weekly implied move, it's very common to break and kind of trade around those levels and just doodle around. Every once in a while, you break and you start moving the other direction. Sometimes you break down from it and you see a huge move because of dynamic hedging kicks in to a fullest extent, and you can see the volume just explode completely. Today, right, we started breaking down from it, but guess what? We closed right back on it, pretty much to the T. If we take a look at Microsoft, we have a wide open weekly implied move, about $399.40 to the downside, $420 to the upside. Now we're below, or we're at a declining 5-day moving average. We broke above, but last week I talked about this of what level to watch, and that was the weekly implied move, the weekly VWAP from the prior week. And why? Because when we broke down from it, we came back, we tested it, we rejected. And right now we're coming back for it again. So my thought here is, and we're above the week to date, and now we're above the last week. So my thought is if we, come in, doodle around or whatever, and we start breaking up and the 5-day moving average starts to turn up, perhaps this changed kind of the psychology of all the buyers and all the volume from the prior week, and that gives us enough push to potentially come into that upper weekly implied move right at about that 420. Okay, another one is Tesla. Right, Tesla, we traded down in this range over here, somewhere around here, and the idea was to come back into the weekly implied move. The monthly implied move. Guess what? We're right there. We've been doodling there. This is right was priced in last month, the lower level. And guess what? What are we doing? Oh, we tagged it, we broke from it, and now we're kind of just having fun there. However, this weekly implied move, we're looking at 375.50, 336 to the downside. What I want to call out here is we are seeing a series of higher lows, price actions getting tight. So maybe if we start breaking these levels and reclaiming that week-to-date VWAP, which was today's, 5-day moving average starts to turn up, maybe that gives us a good risk to reward to come and try to strike for that 375.51. And if we break down, well, guess what? Get out. Like, we'll just let it do its thing, right? We're trying to create good risk to reward trades here. AMD, another one, right? This one got smoked on earnings. It's been smoked, right? It's just been a not good name. This is the earnings volume weighted average price. We're above it. And what I want to call out here is, guess what? We're starting to see actually some higher lows. And you see the dip and they buy it. The dip, they buy it. The dip, they buy it. And today, well, we're kind of just stagnant right here, but we're above this 5-day moving average. We're kind of at the VWAP for the day or week to date. So perhaps if we start breaking through this prior area of supply, this 114.60, what happens, right? If we can have tight risk, this would be our risk, and we can play it potentially up into the upper weekly implied move as a potential target. And that right there offers, 1 to 3 risk to reward if, around those levels. So this could be another one to potentially watch, right? And if it breaks down, give it more time. See what happens, right? We don't know what's going to happen. All we can control, right, is the asset that we're buying, the time that we're buying it, how much of it, and then when we obviously exit the position. 4 things, right? Now let's take a look at market conditions to give a good read here as to maybe help us identify where the market could potentially go in either direction. And as it stands right now, we have a call wall at about 6150. Traders are reaching out to 6200. Good to see. As far as the gamma flip line, it's about 6070 right now, and we are above that. Also a good sign, right? This is where dealers, they'll buy the dip, they'll sell the rip, they'll buy the dip, they'll sell the rip. And this is where volatility typically comes in, okay? So that's a positive sign for moving higher. Okay, now where can we potentially go to? I've been talking about that 6,200 for a while here. I think that's a possibility. I tell you what, as soon as we get into these ranges, Twitter, X, it's going to get lit up. FinTwit about that JPM caller up there at 61.65. This is where you can have some dynamic hedging kick in as well and potentially kind of cap upside in the market. It's very common to break out. People get super excited, so you get a strong move. And if it comes back in, people get all freaked out and so forth. And that's where bull traps can potentially form. Now, I've been talking about the possibility for a bull trap, like a breakout and then a potentially come back in, right? You can't set the trade up for this yet, right? So the idea here is to see if the big move happens to the upside first, then see what price action does and go from there. And if it starts to suck back into this range that we've been trading in forever, well, then guess what? We have ways to protect ourselves when that takes place, which we'll talk about, right? If we get this big move, or if we're just going to kind of keep doodling. The next thing that I look at for market conditions is the direction of the 5-day moving average, and you got checks across the board. They're all green. It means we're all trading above a 5-day moving average that is inclining. XBI finally caught a move back above its year-to-date VWAP. We're basically at it, and it's starting to curl over here. So that's positive. DIA is kind of flat, but it is green. IWM's pretty flat here, but it is green. SPY, it's holding up strong. Q's holding up strong. Semiconductors continues to hold up strong there too as well. That's all I got for you. I'm going to get back to the seminars. See you later, everybody.